Right, welcome back. Good afternoon. So we continue with where we left off. Yeah, this is still in chapter 3, part 7. Yeah, so we have finished looking at doing the common size balance sheet. Yeah, in the last clip. So here in this first part of the clip, we look at common sizing the income statement. Yeah. So the income statement can also be presented in common size. How do we do that? We just take the value of an item for that year divided by the revenue or sales for that year. For example, here 5,000 divided by 5,000, so you get 100%. Yeah. So all other items in the income statement, all these items are expressed as a percentage of sales. Okay, so that is called common sizing the income statement. Yeah, this is different from common sizing the balance sheet. The balance sheet, all items are expressed as a percentage of total assets. Here in the income statement, all items in the income statement are expressed as a percentage of sales or revenue. Yeah, total sales or revenue. Therefore, here, for example, cost of goods sold. Yeah, ignore the negative here. Just stick to $2,006 divided by 5,000, you get 40.12%. Yeah. So here the negative is retained. Yeah, negative here, therefore negative here as well. Yeah. Sorry about that. Okay. So it is 40.12%. Yeah. So all items, for example, other expenses, depreciation, interest, okay, taxable income, tax, okay, then net income and dividends, and retained earnings. All of these items are expressed as a percentage of sales. Yeah. Therefore, here, by doing this, what is the utility of doing this? What's the use of doing this? Yeah. This will allow us to identify expense items that constitute a large portion of sales. Yeah. For example, cost of goods sold is quite high. Yeah. I've highlighted this here. It's 40.12%. Okay, this is quite high, this is quite large. Okay, but is this necessarily bad or is it good? Okay, this we need to make comparison before we come to a conclusion. We can compare either with the company's performance in the previous year, or we can compare with another peer or a competitor in the same industry. Okay, before doing that, we cannot judge whether this is good or bad. Yeah. But here 40.12 is larger than the other proportion, therefore I highlighted this. Yeah. But generally, companies' cost of goods sold, particularly in manufacturing, would be rather high. Yeah. Cost of goods sold would be rather high. It can range from anything between 60% to about 80%. Yeah. Some even higher. But 60 to 80 would be in the normal range. But here it's 40, only 40%. Yeah? This is rather low, which is good. Yeah? If the company can sell the product at a high price, but the cost is only 40%, that is a good deal for the company. Okay, but here the other expenses is rather high. This is 35%, almost 35%. This is, how do you get this value? It is 1740 divided by 5,000. Yeah, that's how you do the other computations as well. I'm not going to go through that. You can do it on your own. Okay, so this tells you that the other expenses are rather high. Yeah? So this figure here, these are all in proportion. These are all proportions. Yeah. Okay, percentage figures. So it tells you that other expenses for the company in 2018 constitute or make up about 34.80% of sales. Yeah, that is quite high. Almost 35% of sales are due to, of sales paid out for other expenses. Okay, what are these other expenses? Yeah, probably we need a breakdown of this. Yeah, but that's not provided here. Therefore, we cannot examine this further. Yeah, but we can note that this is rather high. Yeah, so we need to investigate further why this is rather high. Yeah. Alright, then if you look at the figures for the others, okay, for example here, it tells you the net income is 17.86 of the year's sales. Yeah, so net income is 17.86%, slightly less than 18%. Yeah. So these are quite useful figures, and we'll come back to this ratio. You can remember this ratio later. 17.86. Okay, this is also called the profit margin. Okay, or some other books call this net profit margin. Yeah. Alright, then it also tells you the dividend paid is about 5.8% or slightly less than 6% of sales, and retained earnings. Yeah, it means roughly 12% of sales are retained. Yeah, as reinvestment in the company. Yeah, alright. So these are common sizing, and this method is called common sizing the income statement. So with that, we finish the first method of standardizing. Yeah, there are three methods of standardizing the financial statements. The first one is common size. Yeah, so we'll look at another method next. But note that here, the common size for income statement is only given for the year 2018, yeah, and not for 2017, because information is not available. Yeah, the income statement items are not given for the year 2017. Yeah, but if you are given the information, you can of course do the common size income statement as well. Yeah, for 2017. All right, let's go to the next method. Yeah, of common sizing. All right, let's look at this. Okay, for this, okay, the second method of common sizing is called common base year. Yeah, common base year. So for this, what we do is we express an item in the balance sheet as a multiple of the item value in the base year. Yeah, right. So therefore here, for example, we express this value, cash value in 2018, as a multiple of the value in 2017. Therefore, we take 108 divided by 58. Note that the base year is 2017. Yeah? So the denominator must come from the base year. The numerator is always in the year where you want to determine, yeah, the value. Yeah? So it is 2018, divided by the value in 2017. Yeah? So 108 divided by 58. You express this in decimal. Yeah? And when you state this, you read this as 1.86 times. Okay, 1.86 times. It means that the cash value in 2018 is 1.86 times the value in 2017. So you do this the same for the other items. Yeah. For example, let's take net fixed assets. Yeah. How do you get the value? The common base year value for the year 2018. You take the net fixed asset value in 2018, divide this by the net fixed asset value in 2017. Yeah, so therefore, it is 3438 divided by 3358. Therefore, you get 1.02. So how do you interpret this? It means that the net fixed assets in 2018 is 1.02 times the net fixed asset value in 2017. Is that okay? So that's what it tells you. Yeah. So you can do the same for not only the assets portion, all the items in the asset portion, but you also do it for the liabilities and equity portion. Yeah, here. Alright. So for example, let's take other current liabilities here. So how do you express this? How do you get 1.23? You take 1662 divided by 1353. You get 1.23. Yeah. So 1.23 here means the other current liabilities. Yeah. In 2018 were 1.23 times the value in the value of other current liabilities in 2017. So you do that for all the items. Yeah? So you get this value. Alright, what is the implication of this? Yeah. Okay. One implication is that if the value is higher than 1, okay, then it indicates that the item, yeah, the value of the item of concern has increased over the year, yeah, or has increased compared to the base year. Okay, so for example, these are all greater than 1. Note this, yeah? For the assets portion, all of them are greater than 1. Yeah? And this is also reflected in the total asset value. Yeah? The total asset value is 1.11. Yeah? So it indicates that total assets for the year 2018 has increased by 0.11. Yeah? That means 11%. Yeah? It has increased by 11% compared to the base year, yeah, which is 2017. The amount was 5033. So 5606 is actually 11% increase based on the base year, yeah, 5033. That is why these are all positive, yeah, these are all positive, yeah. And this is the average increase in the asset value, yeah, which is 11%. Okay, so if it is lower than 1, of course it can be lower than 1. If it is lower than 1, it indicates that the item has reduced in value, yeah, compared to the base year. Yeah, so that's the idea behind this common base year of balance sheet. Yeah. All right, you can do the same for the liabilities and equities portion here. So how do you get 1.01? You take the value in 2018, yeah, 307 divided by 303, yeah. So you get 1.01, yeah, rounded to 2 decimal points here, 2 decimal points. So you get 1.01, yeah. So you do the same for all the items in the liabilities and equity portion in the balance sheet, right? So you get these values. Okay, I'm not going to go through each one. But let's indicate, yeah, so what does this indicate? If the value is less than 1, for example here, 0.22, what does that mean? It means that that item has reduced in value, yeah, compared to the base year. Yeah? The value in 2018 has here significantly reduced, yeah, has come down significantly, has fallen significantly, yeah, because it's only slightly more than 1/5 of the base year value. Yeah, base year value is 119. In the year 2018, it was only 26. Yeah, roughly 22% of the base year value. Yeah, so that's a huge drop. Yeah, right. So so this you can highlight. Yeah, if there's, for example, here I've highlighted this. This means this is 1.23. This is 1.28. Yeah, these two are large items. Yeah, that means there's a huge increase in the value of that item in the year compared to the base year. Okay, so this common equity has increased quite substantially, and also, yeah, other current liabilities, you find that it has increased substantially. Yeah, 1.23. Yeah, so how do you interpret this 1.23? It indicates that the other current liabilities item in 2018 it was or is 1.23 times the value of other current liabilities in the base year, which is 2017. Yeah. Okay, so the value is 1353. Yeah. Okay. Right. So another item that you see here, okay, which has reduced over the year is long-term debt. Yeah. It was 843 in 2018, but it was higher, yeah, in 2017, which was 1091. Yeah, so there is a reduction. Okay, so therefore this value is less than 1. Yeah, so it indicates that there is a drop in the value in 2018 compared to the base year, yeah, which is 2017. Okay, so that is what this common base year tells you. Yeah. So the common base year values are all multiples, yeah, multiples of the base year. Okay, so the value in the year 2018 compared to or as a multiple of the value in the year 2017. Okay, that's what this common base year indicates. Yeah. Then there is another method. Yeah, but this video is coming to an end. Okay, we should stop at 15 minutes. So we will stop here and we'll continue with the next method of standardizing, yeah, the financial statement in the next clip, right?